Thank you so much for joining us here on a Friday. I'm Marlon Bowling with you as we come down the home stretch of this trading week. And we want to invite Jim McCormick of Allendale Incorporated in McHenry, Illinois, to join us right now and analyze the opening trades that we're seeing in the grain and livestock trade. Jim, thank you so much. Appreciate that, having you on board with us again. And as we look at the grain market here today, let's go ahead and bring up the corn market and soybean trade first off. And I want to get your thoughts on what we're seeing here. In the corn trade right now on the futures board, we have the September contract losing about 2.25 cents this morning at 368.5. It's close to the low of the day, even though it hasn't had a very wide range. We've had about a 4-cent range, including the entire overnight Globex session. So we're down to, on September, also on December new crop, we're down to at 378.75. Now, if you look at the soybean market today, we have the August contract down 0.75 at 907.75, had a high overnight of 913. So we've come off of that now by about 5 cents or so. September down 0.75, November down a penny at 912.25, but extremely quiet. I mean, extremely quiet. And even with a 2-cent move, the corn is moving more than the soybeans are right now. So what's driving this market here today, Jim? From what I can gather, talking with the analysts here earlier this morning, it sounds like the cooler weather is really taking a lot of weather premium back out of that corn market. That's going to kind of take us up to pollination time.
That's what it is right now, Marlon. I think there's two things. It's definitely the weather. We put a lot of weather premium in when it got hot about a week, 10 days ago. We're bringing it right back out, and that's brought the corn pretty much right back down toward the spring lows as they extract that weather premium back in. The other thing kind of driving it today is it is July option expiration. So you've got some guys, they tend to peg the big strike prices. So July $9 beans and $3.60 July corn might be some targets they look to try to hit as we get toward the close of the day at 1:15.
All right, so you might explain that for our viewers and listeners a little bit, why that happens, why they tend to, as they say, gravitate toward one strike price on the options or another.
Well, they try to go to the big ones because what's going to happen is the guys that own the professional traders like to sell options primarily. So you've got a lot of professional traders that might have sold these 360 July corn calls for 10, 15, 5 cents, selling the $9 bean calls because we've been above those prices most of the spring. Now what they're trying to do is get that market to settle at or below that. So all those options will expire worthless, and they'll come in and book all the profits Monday morning. So they're trying to push it down, plain and simple.
Weather is, as you say, pretty benign for everything right now, and soybeans, I guess there's plentiful world supplies with South America still shipping beans out.
Well, that's it. There's rumors that China's bought somewhere 20, 30 cargoes of beans from Brazil the past week. So, yeah, they're buying beans. They're not buying ours. They're buying Brazilian beans. Corn-wise, Argentina, I think, selling corn for $14 a ton cheaper than we're offering corn. So we've got a lot of competition. And there's one other thing I'm going to point out that's kind of affecting the market is there's a lot of producers out there who have basis contracts, HTA contracts, deferred pricing contracts. They're all coming due. Some are coming due today. A lot are going to be due by Wednesday. So the producers have got to make a decision. Are they going to roll those positions or cash them out, plain and simple? I think you're getting some cashing out at this point, and that's also putting some pressure on the market.
How much is harvest pressure weighing on the wheat market right now, if at all?
I don't think it's having a whole lot of impact on it right now. I mean, you see a little bit of harvest pressure on it, but right now the wheat market seems to be more transfixed on the dryness issues in the North Dakota and what that's going to do to the spring wheat up there. And it seems like if the Kansas Minneapolis wheat rallies, it does it begrudgingly, but Chicago and KC tend to follow it, even though historically those should be breaking as we move into full steam of harvest.
Yeah, that spread is really widening out with Minneapolis wheat over 7 cents higher, as we see on the screen right now. Yep. September up 7 3/4, and the other months or the other exchanges, Chicago and Kansas City, not that strong. We have Chicago just gaining a penny or so. Kansas City just kind of holding its own. Chicago now 1.5 pennies higher on September, and the Kansas City wheat September there is back to unchanged. So we'll pause for a break, and Jim, you and I are going to talk a little livestock market activity when we come back right after these messages. Well, we're back with Jim McCormick of Allendale Incorporated, and we're going to talk now about what's going on in the outside markets and also your livestock trade here. And Jim joins us by phone right now from McHenry, Illinois. All right, Jim, on the outside markets, we were just showing where the dollar is a little weaker this morning, but the crude oil market has at times tried to firm up a little bit late this week. Right now, the dollar down 290 points on September futures on the index, right at 97. Now it's down 300, so it's ticking downward a little bit. Meanwhile, on the crude, we were just talking about this during the break, up 22 cents on August crude, West Texas futures here. 42.96 is our last trade. You say there's a lot at work here behind the scenes in the overseas scenario there, and things could get kind of dicey, so maybe farmers should pay attention if they need to lock in some energy here.
Yeah, I mean, if you look at the headlines, this Qatar deal with the Saudi Arabia, we have a big air base in Qatar, and if that gets, you start getting the Middle Easterns kind of at each other's throats, that tend to put a little bit of risk premium back into the market. What I'm looking at the crude, Marlin, is we've been in a nice downtrend line this August crude. If we take out roughly the 43.50 level, that might be a signal for the producer to come in and maybe get some energy needs covered. As long as that downtrend line holds, I think we could go down and test 40 potentially. But, this Middle East flares up, it starts rallying. That may be a good time to get some maybe, energy needs locked in, especially if you got to lock in some, fuel for irrigation as well as fall harvest.
I'm glad you pointed that out. Appreciate that. All right, let's take a look at our livestock trade, see how we're doing in the early going today. We had just a very, very minor bounce in some of the live cattle trade, especially the nearbys, but we're firming up a little bit as we go now. We have August live cattle now 45 higher at 114.73, kind of in the middle of about a 70-cent trading range here. October 28 higher now at 112.28. On the feeder cattle side, on the August contract, we're trading at 144.35. That's now 90 higher. September up 70 at 143.68. And Jim, you can't ignore the fact that we had the cash cattle trade yesterday that was sharply lower again, even compared to the day before. We lost, a couple of bucks, I believe, on a live basis. And then you had the beef cutout values down yet again. So it's kind of an uphill battle to try and pull this cattle market up by the bootstraps here.
Yeah, it's going to be. I think we could get corrections. I think the story today, we're banning all fresh Brazilian beef. It was announced yesterday due to just poor quality coming in the United States. And I think that's given the market a little bit of a boost. Brazil realizes that's a problem. Their ministers flying over here to try to work it out. I find that kind of comical when they say I need to work it out. It's like, hey, if you want to send us good quality beef, we'll take it. If it's poor quality beef, we're not going to take it. How hard can it be? But that story of this blocking their beef, that's given us a little bit of a bounce, but the bears seem to be entrenched trying to slowly liquidate after this phenomenal run-up we've had over into the late spring, I guess you could say.
Well, and yesterday the cold storage numbers were supportive for the beef side. We were down 10% from a month ago on the beef, down 11% from a year ago. Cattle on feed report comes out later on today after the close. Everybody expects it to be a bearish report. Is it all baked in now?
I think it's pretty much baked in. I think unless it absolutely shocks us, it's pretty much baked in. And and then we're going to come back and see what they do with cash market. Hopefully, we can get a little bit of stabilization and get a bounce in the cash market. Like you said, we've dropped about $10 since last week, which is amazing free fall. But when you look at the packer break evens, they're about $238, $235 in the black. So they do have the money to pay up for cattle if they like. So hopefully, the producer can stand pat and give us at least somewhat of a dead cat bounce on the cash market.
Jim, good stuff. I appreciate that. And lean hogs right now down $1.76 on the August contract at 78.12. They have lost about $4.50 from their earlier high yesterday morning. Jim McCormick of Allendale, excellent information, and hope everybody's paying attention.
Oh, they are, especially when we have those numbers coming out later on today.
A lot going on.
Okay, thank you, Markets Editor Marlon Bowling.